Okay, welcome everybody. Whew, man, what a day, huh? What a couple of weeks. Um, this has been everything is just canceling here in Utah. It's kind of hitting us a little close to home because all these athletic events that are all canceling. One day after one after another. Pretty much started with uh, Rudy Gobert, our big tall center, getting testing positive for the coronavirus. And now our other star player has it too. Donovan has it, and so the NBA all of a sudden suspends completely, like mid game. Like it. I'm also a Mavericks fan too because I'm from Dallas, as you know, and like they found out mid game that the rest of the season was canceled, and they finished their game. Yeah, hockey's done, baseball's suspended. All these college March Madness essentially, like the NCAA's aren't suspended yet, but all the conference tournaments have been canceled. It's insane. It is quite the insane, um, quite the insane thing. It was interesting. I did tweet out. I did tweet out that so they tested all of the Jazz players last night when it was found out that Rudy Gobert was sick and tested positive. And I wouldn't be surprised, George, if after today or tomorrow they just cancel it or at least suspend it, right? Just suspend the tournament to like for a couple of months, and then figure things out there. I highly doubt they're going to go through with it, considering that considering that they've been canceling all these conference tournaments now. But yeah, the interesting thing about the Jazz situation last night, again, it hit a little close to home here because that's where we're at. Um, but they tested everybody there. They tested all the other players. That's how Donovan Mitchell found out that he tested positive. They tested all the other players last night. They tested personnel, like 60 different people that were there. And I think on the Jazz side of things, like press, people that were involved with the team and travel and there at the arena, that were associated with, they had any kind of contact with them. And as of right now, only Donovan Mitchell and Rudy Gobert are the only ones that tested positive. So to me, that's kind of an interesting sign because like they're pretty much in close proximity with each other, especially on those teams. And so we'll see. We'll see how whether that's actually a good sign. The fact that it's not nearly as you would expect, considering how contagious it is, you would expect it to be a lot more. I'm not sure how they're testing, Jim, but I guess when you got the money, when you get the money like they do, right? They can get things that other people can't, apparently. So here we go with the chart. So kind of looking at today, I tweeted out. So here's the Fed action here. I tweeted out like, okay, we are either going to fill this gap in up to 275, so yesterday's gap, or we are going to break this support, right? Break the support and head lower. This because we at the time I tweeted it, we were right in this area. Actually, we were right here at the time I tweeted it. So as of right now, we're kind of fiddling with the support. We're not filling in the gap or coming down. And that's the idea. It's like, and I tweeted even earlier than that. When we were at this level right here, when we were kind of testing these highs, when we were testing those highs, the thought was, is the Fed going to come in now and fill in this gap, and this gap? I don't think we're going to fill it. We might fill in that gap, maybe. So I showed you the 2018 move. The December 2018 move, we did get a big move up that Tuesday after. But now we kind of have to go to a different scenario, right? Because we are now in this mode. We've been kind of transitioning from a intermediate pullback, right? Are we expecting an intermediate pullback? And based on what the VIX was doing, then, okay, are we going to expect a market sentiment pullback? If we got up above 100%, 115%, then it was, okay, are we breaking significantly below the 200-day moving average and the VIX jumping up 125%? That means we're going to have a death cross. And again, that doesn't necessarily mean market sentiment pullbacks and death crosses doesn't necessarily mean recessions, but it does mean significant, it will take a few months, right? With a death cross, we were looking at what, 3 to 4 months? A 3 to 4 month rally to be able to get the dark green shading and the green line again. And then now, that last kind of the last stage of bearishness was a bigger than 20% decline, right? A bigger than 20% decline and breaking down that 62% level. That was our last stage of bearishness, and it looks like that has come to fruition. And I'm using 14 because of that pullback in back here, right? Just to get that one in, because I think that otherwise we don't. If I put 15, then that doesn't show up, and that was the death cross. So I wanted to make sure we get these death crosses here. So now we are below 20%. So what does that mean, right? Again, it's all about length of. We're going to recover. We always recover, right? We're going to recover. It's just a matter of how long will it take, right? If the intermediate line falls below 50, it might take a few weeks. If the market sentiment line falls below 50, we get a market sentiment pullback. We're talking a couple of months, right? 1 to 2 months. Again, before we get dark green shading and a green line again, we start trending higher. Do we get when we get a death cross? Now we're talking like 3 to 4 months before we really get going again. And now with a 20% decline, which we just don't get, right? We haven't got a 20% plus decline on a close-to-close basis since January, or really wasn't even January of 08 because it was here. I'm going to zoom in a little bit more so I can get it right. So here's the close that we came down from. There's the highest close on October the 9th. By the time we got to that low point, that was an 18.69% low. So and that's when we tested the May. We were down here. We did get to a 20%. We didn't even get to a 20% decline at the low there. And we rallied and we failed in May at the 200-day moving average. And you can see, we're looking at still right into here. This was our first 20. This is when it was actually in June or July 2008 that we finally hit 20% down after we had failed at the 200-day moving average. We had hit that 20% down. So that was right here. And then we made another little bounce up higher, and then things hit the fan. So, again, we're talking, this is a little different because it occurred, this is when the death cross occurred in January of 2008. That's the decline that we had. That's the decline we're having now. At least that's the question. The question that on everybody's minds is, are we having another 2008? See here, or that July of 2002, right? Those are moves that ended bear markets. Is this a move that's beginning a bear market, or is this a move that's ending a bear market, right? These moves like this, that spurred on these huge fiscal and monetary stimulus plans that we got in here. And eventually, even at the low point of 2008, so when things really hit the fan here, we double dipped, as we always do, right? We double dip here. So by the time we really got down after options expiration, when we hit that 45% decline there, a year later, so this was October 27th, 08, even with the ups and the downs, back to October 27th of 09, so right, right there. So there's October 27th of 09. That's a year later from that low point. We were up 25%, right? 25%. from one year to the next. That's at the worst of the October, right? We went down again at November expiration, as you can see, and then we went down even more at the March, right? So in a one-year return where we finished the year up 25%, at one point in time we were down 20%. So we were from that low point, which is really dire, we were still down another 20% before finishing a 1 year, so that 1 year return of 25% had a 20% drawdown within that 1 year, because again, how high the VIX is and all of that. So that, if this is October 2008 all over again, then we're looking, at really decent returns going forward. If this is January of 08 instead, right, if this is this case right here, if this is January of 08, 1 year from then, we're looking at, see, when was that? That was the 22nd. So here is January the 22nd over here. This day. We were down 36% a year later. Right? That's much, much different. So what are we? Are we in January of is this the January pullback, or is this the October pullback? Well, let's take a look. Let's take a look at what things look like. Let's go back a couple of years back from, because I want to go back to, January of 18. So it's actually a little bit more than 2 years. It's actually about 2 years and 2 months. So let's go back a couple of years to, let's say, November of, January of 06 would be 2 years. So November of 05. Let's go back to November, and I'm just going to, I didn't write this down earlier. I fiddle around with charts, but then I didn't write down this note. So November of 05. And then we're going to go back a couple of years over here when we really hit the fan in October of 07. So let's go back to August of 06. Okay. And this would be to obviously January of 08, and this would be to October of 08. All right. So with that being said, let's take a look at this. Let's go to asset class comparison. Let's go back to January of 08. So that was what, January 22nd, if I remember right, of 08. And then we'll go back to like November 22nd of 05. Again, I'm going 2 years and a couple of months because that's how long of a time frame we've had since January of 2018, where I think where risk appetite peaked, in my opinion. So, okay, here's the returns. By the time we got to that January, by the time we got the death cross, right? This is right now. This would be when we got the biggest move to the downside that produced the death cross. Okay. You see that we have, emerging markets. Look how bullish, because the dollar was probably down, I would guess, because you have international stocks really outperforming U.S. stocks at the time. You have real estate doing pretty bullish. Small cap stocks were pretty bullish. Obviously, we were starting to pull back from that October high point. But at that October high point, you can see how bullish things were. Bonds were not overbought in the least bit. And then gold was, again, probably because of how strong the dollar. I mean, the gold was up 80%. More of an issue with the dollar than risk appetite. If it was risk appetite, you'd have bonds up there too, and real estate up here too. But yeah, when we look at emerging markets and gold, that's a weak dollar move essentially. Okay, now let's go to October, and it was like October 27th or something like that of 08, and we'll go back to like August 27th of 06. Again, 2 years and a couple of months. And you see, okay, well, here's that same move. And you can see all the equity asset classes down. Real estate was down. Of course, we know it got hit hard with that bubble bursting. You can see crude oil's down. There's bonds and gold. They're not up, but they're also way outperforming. Right? That's what October looks like. Okay. Now let's take a look at what we look like now. So here is today, and we'll go back to that January 26th peak of 2018. right? And that's what we look like now. So what does that look like? Does that look like January of 2008, or does that look like October of 2008? Right? And again, October of 2000, January 2008, we were down 36% a year later. Right? 36%. 1 year later, we were down 36%. In October of 2008, 1 year later, we were up 25%. Up 25% with a 20% drawdown in there. So, I mean, we were up a lot, but we didn't go up every day, right? We had a big drawdown early in that period before rallying up to the upside. Yeah, well, it's again, same story, different details, different characters. So I want to bring up another story, right? Obviously, this has a lot of looks to 2008. It also has a lot of looks to July of 2000 and a lot of similarities here. And I'll get to your questions here in just a second, those who typed it in there. This has also a lot of similarities to 2002. Let's see here, 14 again. And then we'll go back to 2002. So right here in July of 2, this is very similar to July of 02 when things really hit the fan at the end of that recession, right? So right here we had that big decline. If you look at the rate of change, the 12-day rate of change, so I'll throw it on here as well. We'll go 12 days on the rate of change. We're down about 17% right now. So here's July of 02. And we are down 18% on a 12-day basis. See, right now we are down 19% on a 12-day basis. So in 2008, in January of 2008, we were down 8%, 9%. By October of 2008, we had hit 23% down. And then, of course, there in November, we were down another 20%. So, and then now go back to 2002, right here, 2002, and you can see we were also down at 20%, 19 some odd, 20%. By July of 03, so this is July 22nd of 02, to July 22nd of there. July 22nd, no. There. So, is it skipping? No, it's right there. Right there. July 22nd of 02, you can see, so there's a 1-year period. We were up, I'm looking at the top left up there under S&P 500 index, it says 24%. We were up 24% from that low point. Right, and we did have a couple 19% and a 14% drawdown from highs. Right, we had two 20% bounces and ultimately finished up 24%. But with those three 20% bounces that we had, we also had a 19 and 14% drawdown. Again, in a similar period to what we're at now. Okay. Now, the other story we need to bring up is 1987. Okay, 1987. So I need to go back. Let's just go back to the rate of change on a 12-day basis dropped to 30%. I know there's been a lot of things talking about how fast this decline has been because it's from like an all-time high. I don't think that was necessarily, I mean, maybe it was an all-time high or this isn't included in these discussions of really fast declines. Obviously, this is a bigger, on a 12-day basis, we had a 31% drop. This was the Monday, October 19th of 87. That's the Monday, and going into that Monday, just to kind of show you, going into that Monday, we were down the rate of change was down 12%. We were down 14%. And then from that Monday, we were down 20% in one day. 20% down in one day there. So, that, and again, the big rate of change, big decline. And you can see from that point, when things were like, again, we were 13%. That was pretty bearish as it was. But then Black Monday. From Black Monday, we didn't recover immediately. We didn't recover immediately here. But you see, without a 14% decline, we rallied 64%. Right? I don't know. Well, if it happened in one day, we'd shut it down. I don't know if it would happen in one day here. Because, you can see the Fed is used to stepping in. So I don't know if it would. You saw today the Fed was stepping in. It was October the 19th. So let's go to October 19th here. So is this. So from there, October the 19th is this red candle. So right there. That red candle right there. We were up 52%. 1 year later, we were up 52% from the low point of Black Monday. Sorry, you're right. Thanks, Bill. 23%. 52 points. 23%. You're right. We were up still. So it's a kind of a common number here, kind of mid-20s. We didn't have a drawdown. We did have a pullback. We've had multiple pullbacks, but none of them were to the 14% mark apparently because they're not showing up here. And actually it was these two. It would only be these two. This one came afterwards. But you see that even if this is 1987, right, if this is 1987 where the market kind of broke, right, the equity markets pretty much broke those days. Look at the 2 days after. Look at the 2 days after. Right, now you have to, let's do this. Let's look at this one here. Going to come over here. Take off the fit high and the low. And then we're going to go back as far as we can. No, let's go back to 1987. So we don't have to go back super far. Okay, so here we are. And again, you can see realized volatility right now is up to, oh man, I moved this up already today. So it's up to 56%, 56.5%. Oh, it didn't take for some odd reason. Thought I had moved it up today. The 54 number. So there's where we're at right now. So there's 87. There's the big red candle of 87, down 20.5%. There's your next two up candles, 5% and 9%. Boom, boom. Then we had some big down candles. We had a 4% drop and a 8% drop, right? And then that was followed by big up candles. The big up candles here. So big downs, big ups, right? But that set the low point. So now the question is, here, go back to that July of 02. Where are we at? Let me zoom back out. Oh, we're 99, so we're getting close. 01. So here's September of 01, right, which is another very comparable period, though not anywhere close to what we're seeing right now. We did have a down day. We had a 5% down day on, when we reopened after September. In fact, that week when we reopened up till options expiration, and realized volatility got pretty high. So that's another comparable time in terms of a potentially economic disruption. That was a pretty decent. That was a significant economic disruption at that point. Sorry, my wife is. We have in our state we have a press conference going on right now. Telling us about whether our schools are going to, what's going to happen here. So anyway, so my wife is kind of texting me what's going on. But so here is that July. Here's that July period, and you can see again, realized volatility got close to where we're at right now, but didn't quite. Look at all the red candles, boom, 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 followed by a 5.6% move and a 5.4% move. So we're going to get tremendous moves to the upside here. It's not going to be a tremendous move to the upside. It's not going to be like back up to 3,300, 3,400. We're not going to get up there again anytime soon. And if I go back to that death cross here, because I told you now the idea that if we're going to be in a extended death cross environment, right? Not so much like this, not so much like this, but more like January of 2018, right? Like this, because we dropped 20% below, like it could be a few months. Over here, we dropped 20%. I think at that level is when we dropped 20% there. So we were going to be a few months, right? We just dropped 20% so fast. We were so far into it. We were over here. And by the time we got to 20% drop, we were in a death cross environment for months. By the time we got to a 20% drop here, we were in a death cross environment for months. Here, we've got 20% drop, more than a 20% decline. I guess the day is not over with yet. So, we still got an hour and a half. So we'll see what happens. And there is, as of right now, a little bit of a low shadow development. But we'll see. We'll see what happens with where we end up closing today. But assuming that we will close more than 20%, we don't have the death cross yet, which is fascinating to me. Let's go back to 1987 again. That's the other comparable period here. And, go back to a weekly chart. Zoom out all the way over here. And let's do the regular candles for a second. So there's where we are. So there, you notice we weren't in a death cross environment there either. And we had a really high PPO. We had a big divergence. Does that look from, we didn't have a big divergence here, but we kind of did over here. But we had a really high PPO, right? That's how high the PPO got here. 1987, it was even higher. Right? 1987, it was even higher. The long-term, the bullish momentum we had in 87. Now I was like in junior high, so I don't even remember what this was like. But yeah, that just kind of puts this current bull market and then pullback in some perspective here. And then that was the low point, right? We set the low point. That was the Monday. This obviously was the close on Monday. There is the bounce back up by the end of that week, right? So, and then the death cross came after that. The death cross came after that. We came eventually, you notice, within a few, so again, we weren't in a bear market then. Like 02 and 08, we were in a bear market, right? We were in a bear market. 02 and 08, we were in a bear market already. Like we were in a let me rephrase that. We were in a death cross environment for months already by the time we got a more than 20% decline from close to close. Right? 1987, we weren't. Very similar. We were close. We were getting a lot closer the week before, but then that next week, and we were way below the 200-day moving average. Pretty similar to what we're seeing right here, what we saw, and then this, right? Does this not look? We're going to be in a death cross next week. We're not in one this week. We're going to be in one next week. Does that not look like almost exactly the same? From a technical perspective, again, the details change. The details are different. The characters are different. The story is the same. The story arc is the same. The history doesn't repeat itself. So I think we're past the 2011 comparison now, Dan. That would have been, that 2011 comparison is a market sentiment pullback. Because of the 20+% drop from close to close, we are now past that level, right? The 2011 comparison was, okay, we're still less than 20%. We're still at Fibonacci support. it's just going to be a market sentiment pullback where it's going to take 3 or 4 months to really get going again. Well, so now because of today's drop, and assuming we close around, I'm assuming we're going to close more than 20% below today. Then so now that's why I'm bringing this up. Now we're at a 1987 comparison. Because imagine if you had gone long bonds in 1987 at that point. Yeah, I mean, we'll keep in mind, this is a little different, Bob, because the worst day in 1987 was on a Monday, right? The worst day was on a Monday, and then, so that's why you get the long lower shadow. Right now, the worst day could be today or tomorrow. Right? We still could get a long lower shadow going into tomorrow. I think it's almost like, when you have a bad quarter, you just pile up all your bad news into the same quarter. So if you're going to have a bad quarter, you're just going to pile it all up. Well, it seems like today we're piling up all the bad news. Like everything's canceling today. So we're having a bad day, so we're just going to pile everything up on the same day. Everything that's negative, that can cancel, that can be economically disruptive. And we were disrupted. This isn't even unique because our economy wasn't disrupted for months, but when 9/11 hit, I mean, I was an adult there. I was a kid in 1987. I don't remember that at all. I honestly don't. I was a kid. I didn't know what was going on. I just went to school and played basketball and hung out with my friends. 2001, 9/11, I was an adult. I totally remember that. I was out of college by then, so I totally remember that being economically disruptive. It was in the fall, but they had canceled football games. They had postponed football games, baseball games they had postponed or canceled some. I mean, not for months, but so this is a little different because it's in the spring, and so now you've got the NCAA, you have the NBA, which wasn't going on, hockey wasn't going on. It was just baseball. No one cares about baseball anyway. Just kidding. For you baseball fans, there's a few people that care about baseball. But, and football, a lot of people care about football. And so that was a little bit disruptive from an athletic standpoint. But from a travel standpoint, I mean, nobody traveled. Nobody traveled then. 2001 was significant. So now you go back and you say, okay, well, in 1987, it took months to get back to a golden cross environment. Right? It took months to get back to that. Even though the damage was done before the death cross even occurred. That was where the low point was set. Before the low point was set, that it took months. Yeah, it took about, by the time we got there, almost a year. And then we retested, which is not surprising. But we did get up above and stay above. So we talked about yesterday's class. Clarence asked me, how are we going to know if we get to the 200-day moving average and fail, and whether we should be really safety mode like this? You get up above, you can't stay above. You get back above, you can't stay above. So, I mean, that was pretty dire. And then apparently something changed there in May of 88 that got us back above, and then we stayed above. And that was good. And so then we came back and retested, and that's not surprising. And then by October of 88, and we retested again even, we were off to the races at that point. I mean, we were in had a little bit of a decline here in the 90s and a little bit of a recession, and that, obviously didn't help somebody get reelected. And then we're in the 1992, and I mean, we're off to the races at that point. But it took months from the day or the week the damage was done. If this ends up being the week that the damage is done, then because we're about to head into a death cross environment, or a kind of an extended death cross environment, quote unquote bear market. Even some people will say that we are in a bear market right now. No, that's not a bear market. This is a bear market when you have an extended period of time with a death cross environment. And again, it didn't really start until you failed at the 200-day moving average. So I think we are headed into a bear market. This is not a bear market. I think we are headed into a bear market. But I don't think necessarily that means that we're going to go very much lower, because in 1987 we didn't go any lower. We head into a bear market and we rallied the whole bear market, right? We rallied because it was a temporary disruption back then, and that was a pretty significant disruption back then, and that set the low point, and we rallied off of that. Now, and again, you might say, well, we were so bullish this go around. We were so bullish here. Well, we were pretty darn bullish over there too. I mean, the PPO was much higher than it was. Let's go. We're probably not going to. Let's go to linear regression here, and then you can see on a 20-month basis we are pretty bullish right now. Let's go back if I can. 1987. It was, what did we say, October? It was like October 1st or something. Go back to. We'd have to go back to like September 30th. 30th, and then this would be October 1st of 1967. So I wasn't born. My oldest brother was 2 years old back then. Let's see what that linear regression looks like. Oh, we're not going to be able to do that. Let's do this. Okay. So that's what we look like. That's what we look like going into the 1987 drop. And so you say, well, we're a lot more bullish now than we were then, right? We had a crazy 87, and then boom, we were off. We were up. So we must have been really low in 87. Well, not according to this chart. According to this chart, it was we were really bullish in 87. Really, really bullish in 87 already going into that big drop. One big week, one horrible week, and then it took a while, right? All right, so now let's go to this chart, 1987. And let's see how long did it take to get back to a dark green shading and a green line. And we have to go. Dark green shading and the green line. So there's our day, and that was 3 consecutive clusters, and it was nasty, and it was horrible, and that was the Black Monday. And we retested the lows, right? So, I mean, shoot, 2 months later, we were right back down at those levels. I'm sure back then we were probably like, oh, great, we're going to fall off a cliff. Probably not the same because no social media and no electronics and all of that. But still, like, I'm sure people in the industry thought that we were going to fall off a cliff in December. But we hit that low and we rallied again. So we got dark green shading and a green line. I got to go out further, don't I? I have to go out to 88. It took a couple of months, but we got to a dark green shading and a green line. Remember, we didn't get the golden cross until, like, was it October? Or was it like somewhere over here, I think, that we got the golden cross? And then for your chart, it was July. So really, but it was September that we really took a while, right? September that we finally got the golden cross that stuck, right? So kind of like July, this move right here, that got us up above, and we retested, and then this is what got us up above eventually right here, and got the golden cross. So look, like while we were in a bear market, we had multiple bullish intermediate runs. We never did get to that high point for a while, We won't get back to our high point anytime soon, most likely. We're not down as much. This was a 30% decline. We're only down, 25% as of right now. But still, it's going to be a while. But just because it's going to be a while doesn't mean that we're going to keep tanking further. And of course, nothing is ever 100%. And so I do realize that we can keep tanking. The problem is we have to base our expectations off what we've seen before, because that's what technical analysis is, right? With these human characters involved in this market environment, our attitudes and our emotions haven't changed. We're still very fearful, still very greedy. Well, we are, where are we at? At 2. That is a little bit of an issue here when you look at SPY on a long-term basis. There is a little bit of support here at 250, a little bit, not very much of one, before you hit down to 210. That would have been a 4. Like I was looking at that yesterday because I told you, and everybody was like, "Oh, this is gonna be horrible," and I agree, it would have been horrible. To get down to that level, that would have been a 38% decline. That's a tremendous pullback. The typical bear market only pulls back like 30%. So that's what, and obviously we had a 50% decline this last couple, but these were the anomalies, not the rule. And we saw that the 1987 was the 1987 looked like the 1987 drop looked like it was 30+%, and that's all it got to. So there is a little bit of some long-term volume support here, a little bit. That node, this little node, right in this area, that can hold us up at these spots. Obviously, if you go out further, it looks a little different there, right? If you go out further, then there's where that 211 really comes in, and you can kind of see how bullish we have been over the last little bit. When we finally kind of broke out here, and at the end of 16, we were on a really good run, pulling away from these long-term support levels. This big volume node back in, would have been, December of 2016. December 2016, and you go back 10 years before that to 2006, a weekly chart. So that's that volume node that we were breaking out up above and we really have been taking off big time to the upside. So now you can see that's that volume node. That point of control is still way down here, down at the bottom. So you can see how bullish we've been the last 5 years to pull away from essentially the value area and the next biggest volume node. So that's a little bit of a concern. Like Bill says, there's not as much volume below us right now. But if I were to look at, and we can't unfortunately, because SPX doesn't have volume, and I don't know how far back the futures go back. Let's see. See how far back they go. They go back to, on a volume basis, back to 84. So I don't really have a good way to produce the volume profile back in 87. But just remember that in 1987, on a 20, we were 2 standard deviations up above. In 1987, we were 2 standard deviations up above the 20-year linear regression, right? So it's not like we were not bullish then. Linear regression. Go back to 20-year 1987, so it'd be October. We said, jeez, I got the microphone in front of me, so I can't see my keyboard while I'm typing. So, and then go back to October of 1967. On SPX. And that's that I had to go to September actually. Okay, so there we are. So it's not like we had a big level of volume support over there either on a long-term basis. I mean, I can see there's probably one right there. And if I were to throw on the next month, looks like we got down there, right? And I would venture to guess, Bill, just looking at this, not having the volume profile, but I would venture to guess that had we broken that level, the next major level of support, volume support, would have been right there. So I can see. I mean, we could have said the same thing back then on that really bad week. Look at the ATR, the ATR to price ratio. Here, let's go on the daily. Let's go through December. The ATR to price ratio got up to 5% during that big decline. Well, let's look at it now. You think we're going to get up to 5%? Right? Now, I think there's a really, really good chance that we get up to 5% by the time all is said and done on this. And of course, where the VIX is here, I mean, we're going to be closing here. We haven't closed this high since October 2008. So again, I asked the question, is this October of 2008 or is this January of 2008? There's October 2008, and you can see the VIX versus the VXV ratio had jumped up too and is pulling back. And then we go all the way back over here. There is October of 2008, right? October, and we were kind of at this 1.4 level over here too, and that's kind of where we got to today. That's the last time we closed. We closed there at 70. That was on October the 10th. Remember, we had a 20% drawdown, and the VIX actually ended up closing at 80. A couple of months later, a month later. But then 1 year later, we were 25% higher. So is it October 2008, or is it January of 2008? This is the move right here, the drop that produced the death cross, right? That's the move. That's the downward move and the spike in volatility that produced the death cross. So, again, I don't know. This doesn't go back. It doesn't go back to 87, so we can't see 87. It doesn't actually go back to even the 02, 03. I don't believe. Yeah, so there's 87 right there. There's 87 and how high it got. So we're at 70 right now, 67.5 right now. So that just kind of shows you just how crazy 87 was. And then the 02, so July, so let's see. So here's the 02 time frame. The death cross started over here, right? That's where the death cross started. We were in the 30s. Here's that July move. Here's that July move. We ended up closing at 40, and that wasn't, it didn't go very high at all. But that was the highest point of that recession, right? Other than 9/11, right? Which is another period. So does this look like October of 08? Does it look like September 2001? Does it look like 1987, October of 1987? Or does it look like the beginnings of 2008, 2001, where we went into multi-year, long-term, extended bear markets? I think 1980, we're a lot closer to 1987 right now than we are any of those. Because a big difference between now and here is commodity prices, right? A big difference between now and then, 2008, the beginning of '08, and the beginning of '01, the big difference between now and then is commodity prices. So here's '01, here's '08. Obviously, here's the beginning of '08. We were pretty bullish on commodities then. Here's right now, right? Here is the beginning of '08. So we're going into '01. Let's go 12/31 of '07 to 01/01 of be 1987, so 1988. So there's commodity prices, the 20 years commodity prices going into January of '08, right? That's what commodity prices look like. If I go to 20 years going into, would have been, let's see, when did we get the death cross? It was October of 2000, 6 months after I graduated college. So go back to linear regression, and we'll do custom 20, or excuse me, 20, no, custom 20 years. So we'll go to September 30th of 2000, and then so we'll go October 1st of 1980, month, and then we'll do CL. So there's commodity. I mean, there's obviously the Kuwait issues here, and I do remember that too. I was in high school there. So are we into, again, look at where commodity prices were there. They were flirting on an intra-month basis. They were flirting with 2 standard deviations above their 20-year linear regression. That is not the case right now, right? That is not the case on crude oil, and it's obviously not the case on yields either, even though yields are getting a long lower shadow there. Not the case on yields either. And you can see '08, by the time we got to January of '08, we had started to pull back there too. We had started to pull back at that point, but we have been pretty bullish, and we have been not very bullish on yields all the way since October of 18. We've been in a recession. Nobody knows about it. We've been pretty much in a recession since October of 18. So that's kind of what, I mean, we are in a much, much different environment. I don't think we are at the beginning of 2008. I don't think we are. And even if we are, yeah, so that's a little different. But keep in mind, too, Marcelo brings up a very good point. Back in 1987, the PE ratio, the Shiller PE ratio, let's see where we at. Back in 1987, the Shiller PE ratio was, let's bring that up. Let's start off here. It was, so here's 1987 right there. So we were a little bit above 15. So we weren't nearly as overextended as we are now. We were down from the highs, right? We had been more, in the 60s, we had a lot higher level. And that was, keep in mind that yields are so much lower now that the highs back then, the extremes back then, were in the high 20s, low 20s. It is a really good indicator, Terrell. It's just a long-term return expectations indicator, right? You have to keep that in mind. It's not a technical indicator in terms of like, what do I think the market's going to do tomorrow? It's a long-term return expectation. So back in the 60s, going into this 80s, the extremes were in the low 20s. The only one that was higher than low 20s was the Great Depression, but the extremes were in the low 20s. So the fact that we were at 15 was still pretty close to the extremes at the time, but it was down from the extremes, a couple of decades down. Well, doesn't that look a little bit similar to what we are now? Right? The extremes are higher now, and there's a reason why the extremes are higher, because rates were much higher back then and rates are much lower now. So that's why the extremes are much higher now than they were back then. And the lows are going to be much higher too. We're not going to drop down to the single digits because rates are extremely low. We're going to probably drop down, if anything, to the, to 20, back to where these old highs were, to the low 20s, maybe the high teens. That's going to be the extreme lows now, and we're already to 24. So it actually looks very similar, in my opinion, to what we saw back in 1987. Very similar setup. Down from the extremes of what was the extreme back then by a couple of decades, and that's kind of where we're at here. So I remember the PE ratio can still go down with price going up. PE ratio can still go down if earnings goes up faster. Remember, earnings were already negative on a year-over-year basis going into the fourth quarter of last year. On a year-over-year basis, earnings were negative, slightly, very, very slightly negative, but they were way down from their strong positive readings. So we've been in a little bit of a economic slowdown. We just haven't seen it because we're also focused on Tesla, and we're also focused on Netflix, and we're focused on, the FANG stocks, that we don't see that earnings as a whole for the whole basket of stocks that aren't trillion-dollar market caps weren't doing so hot. And all these other risk asset classes were showing us that. We were just all focused on Netflix and Tesla, right, and Apple and AbbVie. Right? So we didn't think we were in a recession. Obviously, we had pulled back there. So Donald's is coming down. I do expect so now here's David Settle talking. Right. Obviously, this coronavirus is going to be an economic disruption, and we've gone now from expecting an intermediate pullback. We've gone now from expecting an intermediate pullback that will last, 6 weeks, 6 to 8 weeks, just like maybe a month or two, to a market sentiment pullback expectation, where we're now talking about a couple of months at least, with the market sentiment line pulling back, to a death cross expectation, where we're looking at a 3 to 4 month choppiness before we get going again, to now an extended death cross expectation. But I don't expect an extended death cross like 2008. I don't think we're here, and I don't think we're here. I think we are here. If we're going to use these two comparisons, I think we are here, and I think we are here. Right? There were still drawdowns. There were still significant drawdowns. And then, of course, 1987, too. Go back even further. I think we are here. Right? Still took months to finally get going. And it took a few months before we got a bullish intermediate run, dark green shading. It didn't happen again. And you think about, look at the cluster we're getting here. And as of right now, we're getting a cluster, or we were getting a cluster. No, we weren't on the week. Maybe was it the Russell that I was looking at that was getting a cluster on the week? No, it was something else. It must have been a stock I was looking at. But there's our weekly. Isn't that interesting that we're hitting the 162% level? That's this is from that. See, what would this be? The last intermediate run. This is the last intermediate run that we had, and we are coming down now. Yeah, I mean, I'm still long those positions, George. I'm still long those future positions, and it's, we get close to expiration, I will roll them and keep them. I'm not going to get out of those positions, of those futures positions, because I've got a lot of cash, right? I've got a lot of capability, and the rest of my portfolio has actually been pretty flat. I've been pretty neutral. As volatile as we've been, if you notice here, if you look at my gains, pretty much day after day, my gains and my losses are all pretty much coming from one position, right? The rest of my portfolio has been relatively neutral, which is perfect. That's the way I want it. So at some point in time, this gap is going to fill, that gap's going to fill, and that gap's going to fill. And that's when I'm going to get out of those futures positions. And I do expect that we'll retest these. There. Yeah. I mean, that's how significant. If you look at that market sentiment, market sentiment already is a really long-term line. But yeah, I mean, it's been above 80 here. It's been really bullish. And if you look at the monthly, this was something else that stood out to me on the monthly too. Look how low the near-term line is. Look how low on the monthly basis that near-term line is. If I go back out further, you go back out further to that 1987 to October right there. Look, the near-term line didn't get that low there. And the momentum line fell oversold levels by the end of November. And then that was the low point, right? Then we rallied from there. So here we are again with as an extreme low on the momentum line as you could possibly get. We got one over here too in May this year. But those are the only two lowest momentum lines that we've had this whole bullish run aside from 2010. There when we had that big significant close, and that was the last time, June 2010, that the near-term line also closed, and of course the intermediate line wasn't nearly as high as it is right now. So this is an interesting chart because and the month's not over with, and you can see it's not too common. Even in the bear market, you notice that the near-term line doesn't get this low. Even in October of 2008. You notice the near-term line didn't get that low here before we eventually clustered there. In July of 02, which is right, so there's September of 01, really bad month. The near-term line got oversold, but not this low. There is July of 02. The near-term line got down previously, but not this low. This is a pretty significant low for the near-term line on the monthly chart, which tells me that the near-term line is probably going to finish the month up higher, which tells me that we're probably going to finish, the S&P itself is probably going to finish the month higher than where we're at right now. Okay? So from a portfolio management perspective in this class, we're set up with a pretty bullish portfolio as in terms of risk appetite. And if this is like 1987, then that's the way I want it, right? That's the way. We do not want futures to rally overnight. No, we don't want futures to rally overnight. We want futures to come down just a little bit overnight, and maybe 1 or 2% down, not 3 or 4, but 1 or 2% down, then rally the 4, because we're going to get a 4. You're going to get a 4 or 5% move tomorrow, one way or the other. It's going to be 3, 4, at least 3. If not 4 or 5% move, one way or the other tomorrow. The question is which way? Well, we don't want the 4% move to be to the upside in the overnight trading, because then that means we'll probably get, it'll probably pull back. And once we start, we want to be down 1 or 2, and then we want the 4 or 5% move to fill that gap in, and then some to the upside tomorrow. We'll see if that ends up happening. Okay? Or if we just finish this week on the low point, like that Black Monday, if tomorrow ends up being Black Friday. So I think if tomorrow ends up being Black Friday, or if today ends up being Black Thursday, then I think our long-term portfolio management will is well set up for a good long-term move from here. I think we need to change. The financial sector will be the biggest beneficiary of the bounce, just like it was before. So we're good to go there. The technology sector will be a leader as well. We'll probably end up putting some money in industrials instead of healthcare, which is where we're in. And then we'll take a look at some of these international placements too. But I like how we're set up, and long-term bonds are going to be really down. So I'm glad that we're not in TLT now. We missed out on the run up higher, but I'm not going to be sad on the run back down lower. Missing out on being out of that. So I like how our long-term portfolio is positioned in this class for this next year. Because again, are we October 2000? Are we October 2008? Are we January of 2008? January 2008, we were down 36%. October 2008, we were up 25%, even with a 20% drawdown. I think we're more like the latter, and our portfolio is positioned that way. So that's our class for today. So hopefully that kind of gives you some perspective. Things are so fluid, but even every single day where it seems like, man, this is different. This is different. We've never seen a market like this before. The reality is we have, right? We have seen, August. There was a time where we looked like, early 2016. There was a time we looked like, May of 2010. Then there was a time we looked like August of 2011. Now it's looking more like 1987. But we've seen, no matter what we've seen this before. And we can be able to see what the market has done in the past and adjust our expectations accordingly. All right. So again, thanks everybody. Have a great rest of your Thursday. Watch for Brandon's Market Outlook later tonight. It's always good. I'm sure he had a great Q&A session this morning with you. But make sure you check him out on the Market Outlook tonight too. If there's any voices that I would personally listen to, and his tweet about the 5-year, when you buy something now, the market closes. Like right now, I can't think of a better time to buy and then sit out for 5 years. Because you're going to get some good values right now on some really good companies. That 5 years from now, we'll probably have some really decent 5-year returns because of it, because of how dramatic it's been this past couple of weeks. So again, thanks. Have a great rest of your weekend if I don't see you tomorrow. Otherwise, we'll have technical analysis tomorrow, and we'll see you in class. All right, goodbye, everybody.